Although I will say, in regards to this particular topic, you want to still educate yourself. So don't count on your CPA to stop you from doing something stupid with your self-directed retirement account. So you need to either always ask that person the question about it, or at least understand some of the basic rules. And then if you have something that's kind of out there or something that's maybe not typical or not standard, then you can kind of go get that consultation and kind of make sure you're not getting something that's not.
You're listening to the AZREIA Show. If you're looking for quality real estate investing information that you can trust, you've found it. Stay tuned and join the tens of thousands of members that have already benefited from AZREIA, your home for education, market information, support, and networking opportunities that will advance your real estate investing career.
Hello, welcome to another episode of the AZREIA Show. This is Marcus Maloney, your host, and I have Mike Del Prete, our Executive Director.
Good afternoon.
And today we're going to be talking about all things kind of accounting, self-directed IRAs. We have CPA Ignatius Jackson in studio today. So how you doing today, Ignatius?
I'm doing great. Happy to be here with you guys. And you got my name right on the first try. That's
Look
awesome.
at that.
Most people take a little while.
There we go, man. I was feeling it from the soul.
I like it.
All right, so just kind of tell us a little bit about yourself, what you do, man, how long you been doing what you do.
Yeah, absolutely. So I'm a certified public accountant, or CPA for short, based in here in Arizona. I've been here my whole life, so a long time. And I do stuff for business owners, real estate investors, cryptocurrency people, all that kind of stuff. So we handle a lot of the more intricate components of taxes, accounting, all that kind of stuff for what you might need for your taxes or accounting needs for your business or whatever else you might have going on. Very active in doing a lot of stuff in the community. Season ticket holder for the Arizona State University Sun Devils. I'm a grad from there.
Okay.
And it's really love everything kind of all Arizona. So, yeah,
all
about
right.
it.
Don't forget the Suns. You're a
Yes,
season ticket holder for
season
the
ticket
Suns.
holder for the Suns as well, and they just got a lot more valuable.
Yeah.
Recent trades, so yeah, it's all pretty exciting.
They're probably going down for a little bit over the last few months.
Man, it was awful. It was actually much needed because my ticket sales were pretty bad.
So good, we got Katie. So
Yeah, can't beat
hopefully
that.
we ride this all the way to hoisting up Lombardi, not Lombardi.
Wrong
but,
sport.
what is it? It's the
Don't even know.
I don't know the name of the NBA Finals trophy, to be honest.
God,
I
I
don't
used to know it.
Yeah,
But
That's
it's
a good question.
the finals trophy.
Yeah, we need one of those. We need one.
Right. So one of the questions that I always hear and people always say is, I need a good accountant. What makes you a good accountant, Ignatius?
What makes me a good accountant?
Yeah.
Well, for me, I like to make sure that I'm doing what I can to save people money on their taxes. So there's some CPAs or accountants out there that all they do is basically turn over returns. They're more about quantity, not necessarily quality. And so you'll often see that and that's one of the reasons why my firm has grown so much, is because we do take our time to actually listen to people's problems, identify solutions to help them save money on taxes. And so we come up with a lot of different strategies. There's a lot of different things you can do, and we try to keep knowledgeable about most of the stuff that are more common for everybody to utilize. And it's just basic stuff sometimes that people are not taking advantage of. Like paying your kids, for example, or using a self-directed retirement account, or real estate agents not marking the boxes, a real estate professional when they have rental properties. There's stuff like that is just kind of basic that people often are missing. So that's one of the distinctions between what we do at my firm versus what you'll probably see at some other places out there, where the cost might be a little bit cheaper, but you're going to ultimately pay more in taxes sometimes because they're missing stuff that you could be doing to save yourself money.
So what about those investors, not me, that wait till like December and they're like, oh, I gotta do all this cool stuff with you, man. So
yeah, it's definitely more advantageous to work with somebody throughout the year, because oftentimes if you come to us during tax season, one, we don't have time to really deal with it, and then two, there's a lot of things that we can't do after the year has already ended. And so really the best time to talk to someone about doing some strategies is going to be that late October, early November time frame, because it still gives you some time to put some stuff into motion before the end of the year and take advantage of some strategies. But really you should be having a conversation with your accountant, I would say at least quarterly usually, kind of throughout the year, at a bare minimum, twice a year, like middle of the year and then towards the end of the year. So not just talking to them during tax season time.
And is there like with you, like obviously you'd probably do some type of consultation, but even before that, I've learned over time is it's more of a wealth building strategy, right? Is there like, can you kind of talk about like someone's becoming an investor or they haven't done it yet and they're experienced, like what's a wealth building strategy all about?
Yeah, so wealth building can take multiple different forms, right?
Yeah,
it has multiple different definitions, but to me, ultimately, what the goal is to just start somewhere. So if you start investing in yourself, I like to use this phrase called #PayYourselfFirst. I use it all over Twitter and everywhere. And it's a very important phrase to me because you got to pay yourself first. So if you just start out with like a retirement account of some sort, whether it's a Roth IRA, 401k, something like that, and just kind of start that process, that's one of the best ways to save for your future and also to build wealth, because it's very friendly when you pass away in terms of transferring to your kids or to your spouse or whoever you might want to transfer some of that wealth to. And so it's just a great way to save in a tax advantage and sometimes tax-free manner, depending on what type of account you utilize. So that's one of the tools. Another tool would be real estate. I mean, which is obviously what you guys do here, Real Estate Investor Association. It's a super powerful tool. So, where people often make a mistake in real estate, to me, is they are selling their properties instead of holding on to them and passing them on from generation to generation. Because real estate is just feel from a tax savings perspective, both while you're holding it and also while at some point in the future when you pass away and you're passing it on. So, wealth building can take many forms, and so you just got to figure out what makes sense for you. Not everyone's going to want to do a rental property, but maybe you want to invest in a fund that does rental properties. Right. Not everyone's going to want to invest in the stock market, but maybe you want to invest in some sort of partnership with somebody else that does some stuff. So you just have to kind of figure out where you want to fit into your wealth building strategy. But at the end of the day, you've got to at least start somewhere. You got to start saving and start investing. Otherwise, you're not going to get to that level of wealth that people often are striving for.
And you could help bring that out of someone, because sometimes you just don't know what you don't know.
Right. Correct. Right. Yeah. So a lot of people are often afraid at the end of the day when it comes to investing. So, for example, people don't know the stock market very well, so they don't necessarily want to put stuff into stocks. You really don't need to know the stock market very well. You just need to invest in a couple safe options, get yourself some stuff going, and once you have enough, buy a rental property or invest in a partnership with someone who wants to run their own property or something. There's multiple ways that you can get it done. And so, just educating them on what you can and can't do. I have a great YouTube channel that goes through some of that stuff out there, and so there's just a lot of different ways you can get into it.
Okay. Great. So we're talking about saving money, investing, things like that. So what would you tell that person that is getting started, getting into real estate, and they're like, hey, you know what? I want to flip properties and then use the money that I make from flipping properties to buy rentals. How should they structure that? I know I'm just kind of throwing out something.
No, it's a great way to get it done. So, if you were into that space, you want to do some flipping. So important to note that flipping is considered non-passive income, meaning you're going to have to pay some self-employment taxes on it, and depending on your profitability for that flipping operation, you're going to want to have yourself set up as an S corporation 9 times out of 10. And so you want to make sure you're working with an accountant of some sort that understands some of those tips and strategies, because that's ultimately going to be how you're going to save yourself money to where you can then take those savings that you're saving from doing the flipping and transfer that into doing some rental properties. And so the nice thing about if your main business is flipping and you're also doing rentals, now you can also qualify as a real estate professional from a tax standpoint. And when you're a real estate professional, now you get to take advantage of taking those losses on those rental properties and also offsetting your income from the flipping business. And now you can get to the point where, hey, you might be in a Donald Trump situation where you don't have any taxes that you owe for a particular year, because now you're taking some of those losses and offsetting some of your other income that you have. So,
Okay.
So a couple things there. So when we're saying, like Marcus said, from flip to rental, so there's going to have to be, would you do like a 1031 or do this through your self-directed IRA? Is there some tools where you can kind of bypass or defer taxes?
So when it comes to flips, 1031 exchange doesn't work. So 1031 exchange is going to be for investment properties, meaning you previously had it as an investment property, you were holding it for that purpose, you rented it out, and then you decided to sell it at some point in the future. Typically, it's going to be a long-term property that you're doing this with as well, so you've held it for more than a year. And so the 1031 probably doesn't work in that situation. As far as some other things you could do, so when you're doing flipping, you're typically holding it for 3 to 6 months. You're buying it, improving it, and then selling it, right? And so that's a short-term capital gain, essentially, is what it ultimately becomes for your first couple. Now, once you get into it more frequently, it really becomes more of a business. And when it's a business where you're doing this consistently, now you're talking about some non-passive income where you're going to have to pay self-employment taxes. So you really want to take advantage of stuff like auto deductions or mileage versus actual. You want to take advantage of doing some meals. You want to take advantage of some travel, write off your cell phone. There's a lot of things that you can actually write off inside that business to help reduce your income. And then whatever's kind of left over, you could then transfer that over into doing some sort of rental investing. Okay? But yeah, the 1031 exchange doesn't really work for flips in that scenario.
Got it.
So I'm going to ask a very selfish question,
Sure.
and you can probably help with this. So normally, most investors are always told by their CPAs to write off as much as you possibly can, right? Because you want to show as little income as possible so you don't have to pay taxes on that. But yet, when you go to qualify for another home purchase or something like that, your income looks extremely low. How can we offset that? How should that investor pay him or herself through that LLC or?
This is a very common issue, unfortunately, when you're self-employed or if you're a real estate investor and that's all that you do. If you're trying to do more conventional loans, so through like a bank where they have very strict criteria, they want you to always have income to support the loan, even if that property has enough income to support it on its own. And so that's where you're going to have to really get it more into the DSCR loans, where you're going to basically the loan is going to qualify pretty much solely based off the income of the property, not necessarily the owner of the property.
Yep.
And so, unfortunately, the downside to those loans is they do tend to have higher interest rates. However, it's as long as the property is cash flowing and it's meeting your financial objectives, I wouldn't be too concerned about that, because I'd rather pay a little bit higher of an interest rate on that rental property as long as it's paying for itself, essentially, than having to pay the government more money in taxes. It's just my philosophy. Now, the other way you can get around it is maybe there's some years where you're not as aggressive, and you don't do that retirement contribution. You don't write off, your cell phone and some of those other personal expenses that you're turning into legitimate business expenses, right? And so maybe you take a break for some of that, and you're only writing off your direct business expenses that are, directly associated with that. So there's really no other way you can kind of get around that, unfortunately. It's one of those things where you can't have your cake and eat it too, is what I kind of say. And so if you're really trying to, qualify for a loan, you have to kind of plan for that in a lot of cases.
Okay.
Because they're usually going to want 2 years of, self-employment income showing that you have a certain level in order to qualify for a more conventional loan.
Okay. Because I try and have my cake, eat it too, and add ice cream and everything else with it.
I have a selfish question too. Around tax time, we like to interview CPAs.
Yeah.
So we get our
Free consultations.
I hear you. It's all good. It's all good.
No, so I would like to be like you one day and have season tickets to the Phoenix Suns. So how do we incorporate that into the business?
Oh, great question, actually. So I actually did a YouTube video on this as well, because I was a lot of people were asking me kind of that question. So here's ultimately what it comes down to. So, and this is exactly my strategy. And I even tell my son's rep, this is what I'm doing. So what I do is I essentially am going to about half the games, and I take my clients with me to those games that I go to. Those tickets, the value of those tickets. Now, if you've never had season tickets, you would know that each game has a separate value. So some games are actually higher, and some games are lower. And so I pick all the lower end games, and those are the games that I'm going to. And those values, those tickets, unfortunately, are not going to be deductible in the business because it's considered entertainment. And under the Tax Cuts and Jobs Act of 2017, that was one of the things that they had to nix in order to get that thing passed.
Basketball tickets
was entertainment.
Oh, entertainment. That's not right.
So it used to be 50% deductible, but now it's zero for the next few years.
But that's if you go by yourself, right?
Nope, even if you take clients with you,
Oh,
unfortunately.
really?
Yeah,
Okay.
yeah. So entertainment, the ticket itself is not going to be deductible. Now, meals, beer, alcohol, while you're doing the entertainment is still deductible. It's still deductible at 50%, but it is an actual deductible expense still.
Wow.
Okay, so now for the tickets that I'm selling, that becomes a cost goods sold. So for those items, it's not entertainment, it's a cost goods sold. And if that's the case, you get a deduction for the value of those tickets that you're actually selling. And so the way it works out with what I got going on, I'm basically making enough from the sales of half the tickets to pay for the whole season. So even though I'm not getting a deduction for it, I'm essentially not having to really come out of pocket for using those tickets.
Okay.
So
cool. So you have to buy the tickets out of your business. You buy it out of your business account.
Yep.
Got it. And then you sell. You go to half. You sell half. Deduct half of the tickets, and you write off the food and beer, whatever you might spend with the client. Got it.
Exactly.
Like your wheels are turning, huh?
Yeah.
So what you got? You recouped your money from the sales.
Yeah.
But what about like
money from the sales,
the deductions? How much does that really help overall?
So
I'm not sure.
It depends on how much beer you drink.
You will have a profit from the sales of the tickets that you will ultimately have to pay some taxes on.
Cool.
But the way that the math works out, you're not really out anything as long as you get enough value on those sales of those tickets to make the additional profit and tax that you're paying kind of offset. So I've essentially taken something that was going to be a cost, essentially, that I wouldn't have gotten anything from, and turned it into something where I'm essentially not paying for it at all.
Got it.
Okay.
So it's pretty sweet.
What's your YouTube page? So just so we know.
So they did this new thing. They rolled out this new thing where it's an @ symbol now. So it's just @ Ignatius CPA.
Cool.
Is the short name to find it.
Sweet. All right. It's always good to have someone in the room that's smarter than you, right, Mike?
Yeah.
You know, especially when it comes to taxes and everything like that. So we're going to take our time to make sure we get all of our audience's questions answered. So
let's do it. Were you going somewhere with that?
No.
Okay, guys.
Go ahead.
So let's jump into self-directed IRAs. Let's talk about that for a second.
For the record, I'm sure there's plenty of topics you guys are smarter than me at, so I just happen to be smarter at this topic. But yeah, okay, so self-directed IRAs. As you can see from my shirt, I don't know if you guys see that or not, but there you go. So I'm a huge proponent on this, and the reason being is most people, when they do retirement accounts, all they think about is the stock market. And frankly, I think that's why so many people are don't put money into retirement accounts. They either stuff it under their bed or leave it in a bank account or have some sort of other investment strategy that they go after. And so, but if you amplify retirement accounts by doing, not only putting it into the retirement account, put it into that tax advantage manner, whether it's tax deferred or tax free growth, right? And then you amplify that by doing something that has high returns, like real estate investing. Let's see, cryptocurrency, typically you can find some good returns there. Businesses, investing in private companies, that kind of stuff, right? then you really amplify that account to where it becomes more fruitful, and people might actually be more interested in putting money into retirement funds. And so that's one of the things that we talk about when we do self-directed retirement accounts, is we're really trying to get people to think about diversifying what they're investing in and doing some stuff besides just leaving it in an ETF or a mutual fund, which is invested in hundreds or thousands of stocks that people don't really know what it is they're even investing in some cases. So yeah, I think that's the importance of what a self-directed retirement account is. And you could do this for IRAs, you could do it for 401ks, you can do it for health savings accounts, you could do it for Coverdell IRAs or education savings accounts, which is for like saving for your kids' college. So there's a lot of different vehicles where you can actually do a self-directed account and invest into something other than the stock market.
Got it. Such as real estate, businesses.
Yep.
Is there anything else? Can you do like metals?
Precious metals.
That's
yes.
one. Okay.
You just can't store the metals at your house.
Oh,
There's a
okay.
huge court case that came out last year that nixed that.
Wow.
Even though most people knew that you weren't supposed to be doing that, there's some people that were being super aggressive. And I always say, be aggressive, but don't be stupid aggressive. So, don't get yourself to the point where you're potentially bordering illegal activity, right?
Gotcha.
Yeah.
Because that's where you're usually going to get yourself into trouble. But if you're smart about it and you're just aggressive, in terms of taking advantage of everything that you can, then that's totally fine. There's nothing wrong with that. That's called tax planning.
And then there's speaking of trouble, there's some rules to self-directed IRAs. Can you briefly go on some of those?
Very good point. There are definitely a lot of great rules that you have to follow. One could say they're great or not, but you have to avoid doing prohibited transactions. What we're talking about there is you can't invest or do stuff that's going to benefit you personally, right? So it has to be something that's going to be some sort of third-party investment. Some sort of vehicle that is not going to enrich you personally, other than having your account grow from that investment, right? So let's say, for example, you bought a house and you were going to rent it out. You can't live in that house. You can't go stay in the house for like a vacation. Your kids can't go stay in the house. Your spouse can't. Your grandparents can't. So there's certain people that have to basically stay away from whatever you're investing in, can't really use it to their benefit or to your benefit. That's one of the biggest ways that people often get themselves into trouble when it comes to self-directed retirement accounts, is they're trying to, again, have their cake and eat it too. It's another phrase that I'll kind of use there too. And so what you just want to stay away from that. Some other things you can't do, you cannot invest in collectibles. So like pieces of art or wine collections or whatever you want to call it, right? You can't do any of that stuff. You also can't own S corporation inside the retirement account. It's just not an actual legal member of an S corporation. And there's certain, if you have precious metals, you have to make sure they're stored in like a safe or a safe deposit box or something like that that's outside of your house. So some other custodian is kind of holding on to it. Cryptocurrency, for example, kind of similar stuff. Like you want to use like an exchange or some sort of third party to kind of hold the investments for you, instead of having technically you could probably have a wallet or a key that you keep at your house, but it gets a little fuzzy. So to be safe, what I would say is probably throw that into a safe deposit box or some third-party storage medium as well. So there's definitely a few rules that you have to kind of be a little careful with, but if you comply with those rules, it's very advantageous. And so what I recommend there is there's a great book by a wonderful guy, Matt Sorensen, called
Self-Directed IRA Handbook.
The Self-Directed IRA Handbook. I thought that's what it was. I was trying to remember off the top of my head.
I was trying to let you say it, man.
So, Self-Directed IRA Handbook. And so I would definitely go out there and get that and read that. He's considered one of the all-time greatest minds in this space. Has been doing it for years. So I would definitely recommend buying that book if you want to really learn all the rules, because there's really so many. There's too many to really dive into fully on this 30-minute podcast. So,
well, that's the reason why you always have to have a good CPA.
Yeah,
exactly.
Let you guys listen and learn all of the rules, and we just follow your lead.
Although I will say, in regards to this particular topic, you want to still educate yourself. So don't count on your CPA to stop you from doing something stupid with your self-directed retirement account. So you need to either always ask that person the question about it, or at least understand some of the basic rules. And then if you have something that's kind of out there or something that's maybe not typical or not standard, then you can kind of go get that consultation and kind of make sure you're not getting yourself into some hot water.
Okay.
Got it.
But yeah, I mean, we're not there every time you write a check, right? We're not there every time you sign a document. So if you want to kind of really protect yourself, I would definitely recommend educating yourself a little bit on it.
Okay.
Perfect.
So one of the misconceptions that a lot of people have is, or one of the questions that always arises, when should I get a CPA? Because some people that just work just W-2, they figure, well, I don't need a CPA. I just have H&R Block to do my taxes. But so when should a person, inquire upon having a CPA as a member of their team?
Great question. I have this conversation all the time with people because we receive a lot of calls from people wanting us to help them out. And to me, my personal opinion, if all you have is a W-2, maybe you have a little mortgage interest or something from your house, you really don't need anybody to do your taxes. In fact, you're probably wasting money having people do your taxes. Doing like a TurboTax or a Tax Act or TaxSlayer or one of those guys, I think is going to be more than sufficient for, I'd say, like 80% of the population here in the U.S. Now, the other 20%, we're doing crazy stuff. So we got cryptocurrency, we got businesses, we got self-directed retirement accounts, we got rental properties. So, if you're doing that kind of stuff, that's where it makes sense to have a CPA or some other knowledgeable accountant. There's a lot of people besides CPAs that are very knowledgeable about taxes, like enrolled agents. I'm going to give those guys a shout out because there's a lot of great enrolled agents out there. And so you just want to make sure you got someone that's really good and beneficial that knows what they're doing to help you out, because the cost of doing that will outweigh the savings, should outweigh the cost of spending that money at that point. When you just have a W-2, there's really nothing I can do for you. So you could be paying someone $500 to do your return, and you could have easily spent $50 or $100 on one of those self-filing programs and saved yourself a few $100, because there's really nothing that we can do if you're not doing anything.
Right.
I mean, if all you got is a W-2, unfortunately, the tax code is not set up to save W-2 employees money.
Right.
That's what I always tell
Say
people.
say that once again.
It's not set up to save W-2 employees money on taxes. Your taxes are your taxes when you're a W-2 employee. You really have to have a business, rental properties, some sort of investments, stuff like that, before you can really do anything advantageous.
Okay.
Love it. So the one thing I like about you are an investor yourself.
Yep.
As well as a CPA. So I kind of want to just, short-term rental is always a hot topic. So maybe we could talk about, I know you have some. You have a few yourself, right?
Yep.
Here in Phoenix?
Yep. They are here in Phoenix. All my short-term rentals are here in Phoenix. I have one long-term rental that's in Kansas. But yeah, most of my short-term rentals are here in Phoenix.
Kansas been a theme today. Huh?
Yeah, we've been in a lot of Kansas talk.
Yeah?
Yeah.
And
What part of Kansas?
It was Kansas City.
Kansas
Kansas
City.
City? Yeah. That's where my long-term rental that I have there is at. Although I have a client who's recently gotten really involved in Wichita, Kansas.
Okay.
So, yeah.
Well, let's be careful here, because I learned something this week.
What's that?
Don't laugh, but there's Kansas City, Missouri,
Yeah.
Yep.
which I didn't know that's where the Chiefs played.
Yeah.
Sorry, football fans.
Yeah.
We just did a deal out there, and I was like, Kansas? Oh, we did a deal in Kansas. Sorry, that was the first time I ever did it. And he's like, no, Missouri. I was like, huh? It's like I kind of throw it off. So you're in.
We're on the Kansas side. Yeah.
Okay, so it's on both sides.
Yeah.
Got it. See?
So you got
I need a map
Kansas
or
City,
something.
Missouri, and Kansas City, Kansas.
Yeah.
Got it. See?
And they butt right up against each other.
They do.
This is
They're
crazy.
literally, you cross a river and you're in a different state, but it's still called Kansas City for the city. Yeah. It's pretty crazy.
So I was able to prove I'm not the smartest in the room. So let's now what's going on in the short-term rental world? I know we did a lunch and learn a few weeks back, but can you talk about the exemption? So kind of give us a little update on that.
Yeah, so a little short summary about that, right? Definitely go check out that lunch and learn for the full details. But in essence, what you can do, if your average stay for each customer that stays in the short-term rental or Airbnb is 7 days or less, right? then that is considered a short-term rental underneath the tax code, and which basically means it's non-passive. Okay, as long as you're materially participating, then it becomes non-passive. Let me just clarify that. So there's really two qualifications to get to that point. It's average stay of the customer is 7 days or less, and you're materially participating in that rental activity, which there's a laundry list of stuff that you can kind of factor in to where determine if you're materially participating. But basically, if you meet those two criteria, then you can now consider it non-passive and write it off any losses against your ordinary income, meaning like your job from your W-2, from business income, from investment income, all that kind of stuff. You can kind of offset that now. And it's super beneficial usually the first year or two to try to meet that definition when you actually have losses from that short-term rental. Usually after that, you're not usually going to have losses in the short-term rental because there should be very profitable usually. So you probably won't see much benefit after that first year or two of doing it. But it's a great way to kind of get yourself some initial losses to help offset your other income.
Love it. Is that new?
Yeah.
Did that just recently come out, or has it always been?
Nope. It's been that way for years. It's just not something that people have really talked about or
Got
really
it.
dove into too much. And so it's something that, even a lot of CPAs shy away from. CPAs and other tax preparers, because they don't really understand where it comes from and why it's okay to utilize that rule. So think about it this way. Hotels would be considered passive activities, right, if it wasn't for the fact that they had an average stay of customer use of 7 days or less typically, right? And there's even another category beyond that where if you use 30 days or less and you're providing substantial services or activities, then that also is considered a short-term rental, in which case it's non-passive as well. But in that case, you're actually in a self-employment tax situation, which is where a lot of hotels fall. So the same rules that the hotels are using is what any business owner is able to use. So a lot of the rules that big corporations use are the same rules that you as the small guy, the small fish, can still use. You just have to understand and know how to use it. So
Love it. That's so. Yeah, if you can't read the tax code yourself, hire someone that does.
absolutely.
Yeah.
And is willing to be aggressive with you, right? Because there's a lot of tax professionals out there, no fault to their own. I mean, everyone has to take their own risk and tolerance and determine that for their business, right? There's some people who want to be uber conservative. And so if you're being uber conservative, you probably wouldn't try to do the short-term rental thing, right?
Yep.
If you want to be a little more aggressive, take advantage of the short-term rental exception. There's nothing wrong with taking advantage of it. It's just that it requires a little effort and work to make it happen. So,
Okay.
That's huge.
yeah.
So what about working with investors that have properties in multiple states, have income coming in from multiple states? Because a lot of our members, live here in Arizona, but they invest in Illinois, Cleveland, Indiana. How do we make sure our CPA is doing everything right when it comes to that?
Yeah, a very good question. And so a lot of that is you making sure that you're telling your CPA or accountant that's helping you out that you have that going on. So unfortunately, we're not mind readers. So, and I often kind of come up to this issue where something happens. I got a client that receives a letter in the mail after we filed their return, and they're like, hey, I got this letter from the IRS or from the state. They say that I owe them more money. I look at it and I'm like, well, you didn't tell me that you had this going on.
I got one of those last year.
So, is this factual? Is this some sort of fraud? I mean, we got to figure out what we're going to do with it. And lo and behold, once they find out what it is, they're like, oh yeah, I forgot to tell you that. Yeah. So, it's just one of those things where you have to, a great buddy of mine, Mark Kohler, he uses this all the time. You got to be the captain of your own ship, right? You can't just give stuff to someone and say, here, take care of this. I mean, you got to also be involved in it. You got to understand it. You got to review your return and make sure that everything's on there that you would expect to be on there based on what happened during the year. Because you're the one that's going to know best what happened in your life for that year. And so if you know you have 3 rentals, look at that return and make sure 3 rentals are on the return, because you can easily see that those are on there. If you know you had interest from several places, look and make sure that you have interest from all those places. So there's just certain things where sometimes people, I think, take too far of a step back and are trusting a little bit too much. And that's how stuff can get missed, right? Sometimes we make mistakes. I mean, I'm not perfect. I've made mistakes. We all make mistakes, right? But in a lot of cases, it's just that the client didn't tell us that they had something going on, and so, or their reports they gave us were not complete. So there's some sort of issue like that happens, and so we end up having to kind of fix it. So
that kind of reminds me of Steve Harvey's story, where he said he was just giving everything to his CPA and was letting them do it, and then he ended up getting a bill in the mail from the IRS for $1 million. And he was like, well, where did this come from? And his CPA just was never filing his taxes.
Wow. Well, so again, you have to sign your tax return before it's filed. So if you're not signing anything that this thing was completed, that's a telltale sign right there. That means it wasn't done. So you got to make sure that you're receiving a copy of what's been filed every year, because that would be your defense. If you signed a form that said, hey, I agree with this, let's file it, and the CPA didn't file it, now it's on them because they didn't take the action that they were supposed to take. Okay, but if you don't have any of that documentation, there's nothing you can do. You can't protect yourself.
Right.
So that's actually a great example where, and that happens to a lot of celebrities, unfortunately. Where they trust that their advisors and people are doing everything for them, and unfortunately sometimes stuff can get missed if you don't take some responsibility in the process. So
absolutely.
Cool, man. So not only you gave us a lot of great information, just we didn't mention you're a business associate here at AZREIA now, officially.
Yes. Yeah.
Congrats.
So welcome.
Yes. Thanks.
So,
happy to be here. So.
If you see Ignatius at the meetings, I know you come to the subgroups and everything. Your information's on our website. So welcome, and for everyone listening, how do we get a hold of you, man? Like, how do we keep in touch?
So best way to reach us is going to be calling our firm office line, which is 480-542-0404. So that would get you in contact with my admin. He'll do like an initial discovery call with you, and then we'll kind of let you know if it makes sense or not. I will tell you can also go to our website, which is iljcpa.com. Currently, we're looking at actually replacing that with a different URL, but for now, that's what it is. And I will say that we are pretty busy and pretty packed, and so you really have to kind of be that ideal type of client, or for us to kind of take you on. But we do have a few referral partners that we can kind of send you over to if you're having trouble finding somebody who could probably help you out if you're not kind of that ideal client right now. And really what we're looking for is someone who's a little more mature in their business. So not, brand new, just starting out. I do offer consultations for those type of people where you can, it's $300 for an hour consultation, and we'll go through and we'll give you just some basic information about, hey, this is some things you want to consider and think about as you're starting out. This is kind of some stuff that you can ask someone as you're kind of searching for someone to help you out with what you got going on, just to make sure that they're comfortable with what your plans are. And that's usually pretty helpful for a lot of people.
Sounds like it,
when they're kind of starting out.
Okay.
And that's really all that most people even need when they're first starting out. It's just kind of like a little conversation with someone to kind of get them on the right path financially in relation to their tax structure and picture. And so that's what I would probably say is for most people that are in that stage, that's all you really need. And then once you kind of get a little more mature, where you have a lot going on, you're profiting some decent dollars to where we can actually do some strategies. Because in a lot of cases, we can't save you a ton unless you have extra money to kind of put towards stuff. You got to be able to put money into accounts or to go and buy something or do something like a vehicle or take a trip or stuff like that. So if you're barely making ends meet based on your profit from your business, then you're probably not quite ready for us, because there's not much that we're going to be able to do to save you from a tax standpoint, until you have some extra disposable income that we could put to use and do some other strategies with. So,
sounds like a good plan.
Yeah.
Love it, man.
Perfect. Well, Ignatius, thank you so much
sir.
for being here. Thank you for being a business associate, and we will definitely love to see you around the community.
Absolutely.
And that way some of our members can walk up to you, shake your hand, and
Yeah.
ask a few questions. So, another episode in the books
Another one.
for the AZREIA show.
Woo.
You guys know what to do. Get out there, take massive action, and all of the resources that you need are right within your fingertips. So go out there and get them.
All right. Thank you.
See you guys.
Thanks for listening to the AZREIA Show with your hosts, Marcus Maloney and Mike Delprete. We hope you enjoyed this episode. If you found this information valuable, head over to AZREIA.org and learn more about our community.